Welcome to this week's edition of Rolling Trades with RJO Futures. I am Bill Dixon, Senior Market Strategist. I'm going to do a quick recap here on Q3 in stocks, metals, and energies, and then also kind of see, just touch on some of the recent news with the Fed, government shutdown, and how we see that affecting some of these markets in Q4. Going ahead and starting up with stocks, the S&P was up a solid 8% for the quarter. September's typically a weaker month, usually down about 0.5% on the month, but we continue to print new all-time highs, which is great to see. NASDAQ up about 11.2% on the quarter. The Dow lagged at about 5.2%, so still, pretty good from a quarterly basis here. Metals, gold was up 17%, best September since 1979. Silver up about 20%. Platinum was the big leader here, up about 25%, putting it up about 60% for the year. And copper dipped about 4.5%, largely due to Chinese slowdowns in China, and also tariff news. However, we have seen, about 3.5 weeks ago, saw a pretty big resurgence, or it began when we did have a mudslide at a significant mine in Indonesia, resulting in some deaths, some missing people, and then also Freeport even had to go ahead and declare force majeure. So I have seen some estimates. I would assume these are probably on the higher end that said it could affect mining in gold and copper up to about 35% through the end of next year. That would be a pretty bullish development if that came into existence here. We'll see how that plays out. Crude. Going into energies here, crude was down about 8%. Obviously, you look at the news, supply, we got a glut of supply, demand there. While it's still, okay, is it enough to go ahead and really push us back into the $70, $80 range? We've got a long way to go here. So both the supply and demand news pretty bearish. Nat gas, on the other hand, was up about 10%. Nice little charge there. Europe continues to be a big buyer, and domestic usage was up as well. Europe, obviously, no longer relying on Russian nat gas has benefited us. As a result, we saw some higher prices there. So looking at the economy on the whole, obviously on September 17th, the Fed went ahead and cut rates by 25 basis points. Now, looking at some of these numbers, you can kind of understand their reluctance to do so. You got GDP forecast at 3.8% annualized, consumer spending up between 4 and 5%. CapEx up 5.2%, inflation 2.9% year over year, which is obviously higher than their 2% target via the last CPI reading. And so all in all, we got a strong economy. Now you've got an easing Fed, and they're worried about supporting the labor market was the shift that they kind of made. So they're going to let it run hot for a little while. As such, I would expect prices to remain, elevated. I know Powell touched on high multiples or high stock prices and whatnot. And we did see a little bit of a sell-off, but quickly regrouped here. A lot of times too, when we see these conditions, it does help some of the, the latest rally has largely been supported by a handful of stocks. And now I think you will start to see some more participants given the stance by the Fed here. What was concerning, and I think what they probably saw and wanted to get ahead of, where they're willing to be a little bit, let's just say, a step behind on inflation. When you look at the employment side of things, let's just say going back 10, 12 months, you'll notice that the job openings have been falling or down about 1 million from where we were about 10 months ago. And the unemployment rate has ticked higher. Now, are these at, concerning levels? No. There's still a lot of job openings. Unemployment isn't horrible yet. But if the trends continue, we could have, a pretty dramatic slowdown. Obviously, you'll see those reflected in consumer spending, which is still strong. And, several other markets, we are starting to see the housing slow down a little bit, which, also kind of concerning. So we did the 25 basis points already. We're 99% odds currently, subject to change. Obviously, that we'll get to another 25 in October, and 87% odds, if I'm not mistaken, that we'll go ahead and get another cut in December. So looks like we'll be 50 lower by the end of the year. A lot of time between now and then that is subject to change. So we'll continue to monitor the data largely about labor and inflation, which is going to be a bit of an issue in the short run. I don't expect the shutdown to continue for a super long time here. I know Speaker Johnson mentioned yesterday that Earliest would probably be early next week. I wouldn't be surprised to see it extend a little bit further. However, touching upon those numbers again, I don't think that we're going to see a dramatic effect on the economy unless this thing stretches out for several months, which is unlikely. I don't think anybody wants to see that. Probably find some middle ground and get things rolling again here. We did see a soft ADP number yesterday. So again, that kind of contributes to the Fed stance or justifies the Fed stance, I should say. Saw some downward revisions in the last jobs number as well. So we've got a measure of this bad news is good news because it invites further easing from the Fed. And I think, stocks could go ahead and benefit from that. It's a bit of a reflation trade as it relates to commodities, which tends to favor your metals again, crude oil and also grains. On the side of grains, looking at Tuesday's number, which was an ending stocks number, we've got a pretty hefty amount of supply. I think they'll have a little bit of a harder time, mounting meaningful rallies. They can certainly go a little bit higher. They're somewhat cheap. The dollar is relatively low. Looks like it's probably going to remain low, if not go a little bit lower. So those are supportive, but again, the supply thing, there's a lot to overcome in the grain market. So that's going to be a tough one. But as far as, building on the shutdown again, there's, Medicaid, Medicare, Social Security will still go out as planned. If you need any kind of administrative services in regards to those can certainly be affected, delayed, if not reduced. But the Fed has obviously taken the stance where inflation is a little bit less of a concern. Obviously, still a concern. They haven't abandoned the dual mandate, but it's taken a little bit of a backseat as they try to strengthen the labor market here, and as such, should be supportive. So, if you're interested in hearing how we're positioning in some of these markets, some of the trades we're putting on, obviously, given the levels that we're trading at in many of these markets, particularly metals and stocks, there is some significant downside risk involved. But there are ways to go ahead and mitigate that. And if you'd like to hear some of our strategies, please give me a call, 312-373-5342. My email address is B as in boy, Dixon, Dixon at RJO Futures. Look forward to hearing from you, and thanks for your time.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.